Selfwealth Live, the technical analysis edition. We're here for another week. Jason McIntosh is to my right, I believe. How are you this week, Jason?
Hey Roger, I am well, thank you. It's interesting having a look at some charts before coming on, so we can talk about all that and as we get going. But yeah, I think we should have some good stuff to talk about this week.
Fantastic. We've got a bit to cover because I think we're going to try and answer some of the questions that we didn't from last week. But before that, what we're going to do obviously is our regular sort of general market analysis. We're going to talk about market structure this week and what you should sort of know, before you actually enter a trade, even before trying to enter a trade, how the chart should look, I guess, and what you should know about that market structure. And then obviously we're going to go to your questions. Feel free to still continue posting. We've got a few in there already that we're going to go over, but feel free to post them there as well. And any tickers that you might want us to have a look at, then feel free to do that as well. Welcome everyone here on the line. We've got Alone Will has said to you, nice painting, Jason. So it is a beautiful painting. I still yet to put something up on my wall, but I'll look for that next time. All right, Jace, before we get going, what's the go? Can we have a look at our disclaimer, please? Just making sure that everyone's aware.
Yes. So everything we do today is general commentary only. And that just goes through it in this disclaimer. So general commentary, no personal advice given. I'm not part of Selfwealth. I'm Motion Trader. Motion Trader is my business, and that's the first disclaimer is all about me, all about my license and so on. And below that, you've got the Selfwealth disclaimer. So important information, and yeah, always important to remember everything is general commentary only.
Yeah, general commentary, do your own research. We certainly don't offer any personal advice. And you've always just got to remember whenever we talk about stocks, or whenever we talk about stocks past the fact, you might see a very well-performing stock over time, but that doesn't mean it's going to equal the same thing in the future, right? So past performance doesn't necessarily equal the same results or better, right? It could actually go the opposite way, all right? So just as long as everyone's aware, we've got all that sorted then, Jason. All right. So let's have a look at all the markets. What's the ASX looking like? It's starting to pull back a little bit, starting to slow down and pull back.
Yeah. So let's start off with the ASX. So I'll just get our chart up on the screen, and so interesting question to consider this week. So this is the ASX 200. There's plenty of data going back to the 2020 low. A rally, big sideways period, starting to break upwards. And the interesting question to ask is this all-time high from Friday week, is that going to be a lasting peak, or is it simply a pause in an ongoing trend? And I think that's the big thing people often worry about when a market does hit an all-time high. They worry about, well, when's the run going to end? It's always looking for that and worrying about that potential endpoint. And I think the thing to look at here is like we look at this and go, look, what's actually changed? What's changed from a couple of weeks ago? And it's really only like 3 down days is what's changed. And the down days, of course, down days are often larger than up days, and they get people's awareness about things pulling back. But look, I think that when we boil it all down, we look at it all, where the situation overall technical situation is largely unchanged. We've still got these rising moving average. So that's the underpinnings of an upward market. So of course, when a market ultimately does peak, the moving averages would have been rising then as well. But that's sort of the underlyings of any upward trend. We're going to get rising moving averages during the bulk of that move. So at this point, those moving averages are up. And we also have had a market which has been finding support on pullbacks. So these pullbacks over the last couple of months have been finding support. Yet to be seen how the current one will play out. And the other thing we need to remember is we also have a market that's put on 16% over the last 4 months. So from the October low through to the recent high, 16% in the last 4 months. So from that perspective, it probably really shouldn't be of any great surprise that we're getting a bit of volatility, that we're getting a bit of a pullback, because like what we saw during December and then into January, February, it's just not how markets work week in, week out. We're going to get those pauses along the way. So my approach with all this, as we speak about most weeks, is that I've been going with momentum. So ever since we started getting above these moving averages, so I got the 50 and the 100-day moving averages. For me, it's really been that process of investing into the market, investing with the flow of money, investing with the momentum of prices. And it also hasn't been about chasing stocks that have run hard. It's about getting into stocks as they're starting to maybe rally above their moving averages or rally off their moving averages or break out of trading range. We can look at all that stuff a little bit later, but not about chasing a stock which has already run a long way. Because stocks, of course, that run hard can also pull back quite a bit when the market pulls back. Having said that, though, if you're in stocks which have run hard, well, I think that's great. And I'm in that position myself. I'm in stocks which have run quite well. And in that situation, I want to let them run. I don't want to sort of like guess at the peak. It's like if something's been working, just let it keep working. But I don't necessarily want to then come in and keep adding as prices rise. I don't like chasing those ones that have recently run hard, which I'm not in. I want to show you what I mean on this. What I'm going to do, I just want to go over into my Selfwealth account. So as all our Selfwealth viewers will recognize, this is inside the accounts, the dashboard. And what I want to do, I just want to jump over into the My Portfolio section. And want to show you what I mean about how I've been managing my portfolio. I'm going to sort by profit and loss. So I've got the best stocks up the top. And this is what I mean by, like, if you've got stocks which have run hard, well, at least from my perspective, I've got stocks which have run hard. I don't want to start selling out of them just because they've run hard. I don't necessarily want to come in and buy them at the highs, but I want to keep them working. So just looking at these top few holdings, the top holding, MRM's up 230%. Then we've got 227%, 150, 148, and so on. Then we get into the 90s. So the key to, I think the key to having a strong performing portfolio is you've got to let these winning stocks run when you get them. And if they run hard, that's great. Let them keep running. But there's a distinction between holding something which has been running hard and buying something which has been running hard. And so that's kind of how I'm trying to manage my portfolio. And then, of course, you scroll down here. It's not all winners. We get down to the bottom end, and they're the stocks which are underwater as well. There's not that many. Most of my portfolio has been doing well. You've got to get down to down towards the bottom before we get the ones and losses. Not too much going on there, just a couple of percent, 4%, 5%. This one here, Hum Group's down 24%. So that's right at the cutting point. There's not much leeway in this now. That's pretty close to going out the door. But as you can see with my portfolio, I don't have these bottom dwellers which are down 70% and 60% and 80%, which I wish I would have cut ages ago, because I'm constantly cleaning out the stocks as they reach their exit point. But I'm collecting the stocks which are running hard. So you got the bottom end, which isn't too bad, and then the top end, which I think is sort of like what a lot of people would like their portfolios to look at. It's about letting those winning stocks run. And the other thing I was just going to quickly show you while we're in here, it's just the performance versus the ASX 200. And this is what I mean by that buying into strength. So just since this October low, 5 months ago, I've been buying stocks as they've been rising, not trying to pick the lows in stocks, but buying stocks with momentum. And you can see I've had this nice outperformance over the last few months. And just now with the market pulling back, I've still got a strong stock bias within my portfolio. It's been holding up better than the market so far. Doesn't always work that way, but But that's, this can be it's all about, for me, it's all about that rules-based investing, buying as prices are breaking upward, selling when a stock is no longer working. It's, I think they're really important things to take on board. And so just coming back to that ASX 200, just looking at this now, it's back at the 50-day moving average. I think this has been a key support. It's been a couple of times ASX has come back to this 50-day moving average and then had a rebound. Got to wait and see what it does this time around, whether it finds support. If it doesn't find support at current levels, well, then maybe that means we're finally going to get that larger consolidation from this big rally we've had from the October low. It's, as we say, it's not always going to be that one-way traffic. But at this stage, I think the overall trend is upwards. I want to maintain exposure to the market. I sold a stock this morning, and yesterday afternoon, this morning, it was one of those stocks which was up over 100%. It's not in the portfolio now, so you didn't see it a moment ago. But it was one of my best performers, but it has come back and it hit an exit stop. I think we might be able to have a look at that later on. So, at the moment, I'm maintaining all that market exposure. I know it's not going to go up every week. The last 4 months, this has been terrific, the last 4 months. Some great gains. But, we just don't forget. You get a few good months, it's easy to forget that it's not all plain sailing. We're going to get plenty of that turbulence and uncertainty along the way as well. It's not meant to be easy. And got to always keep that in focus. And these pullbacks, they make people worry, but we can have strategies for managing these pullbacks, looking at the market structure of the individual stocks we're about to have a look at, and using those wide trailing stops. That's what I'm doing, those wide trailing stops to try and see off those pullbacks when they happen and try and stay on board trends.
Yeah, a couple of things. One, Jason, I'm very envious of your portfolio. And two, I wonder if this, when we talk more a bit about market structure, I wonder if this is finally that break and retest of that strong, 4-zone sort of support now. So where resistance has now become support finally. But that's obviously time will tell, right? Let's have a look at the US market, please.
Yeah, so the S&P 500. I think the strategy here remains the same as last week and for the last several months, for that matter, and that's let profits run. We've still got a clear upward trend. So, I think for anyone in this market, that's the play. It's just keep the upside potential opened. This market, it will pull back at some time, but we just don't know when. So, as I say, it's a case of letting profitable positions run for as long as possible, trying to guess where the top is. You could have been out anywhere in those earlier months and now be looking on from the sidelines, being unhappy about it. So, whether the top's going to be around here or whether it's going to be a few months down the track, we don't know. So it's about leaving upside open when the trend is moving in your favor. I think that's a really important thing, and that's the whole point of looking at some of those stocks in my portfolio earlier. They're only in there because I left the upside potential open. It wasn't about trying to resist. It wasn't about taking early profits or getting scared. As the market went up 20, 30, 40%, then pulled back, it was letting things run when they're working. But I think for anyone not in the market, anyone not in this S&P 500 at the moment, for those people, I'm probably not as enthusiastic about buying at these levels. So I'm saying, if I'm in there, I'm letting profits run. But if I'm not in there, I'm not keen to come in and buy at this current point. And that's because I just don't think this is an asymmetric entry point where we currently are. So when I talk about asymmetric entry points, it's about having an asymmetric entry point is where you think that your relative downside is smaller than your relative upside. So I like to think in terms of a 3-to-1 ratio. It's just a rule of thumb. It's roughly speaking. I want to say that, look, if I think I think my potential loss is 1 unit, I think my potential profit is at least 3 units, and that's a good basis going forward. That's what I like to look for, and I'm just not confident about that at current levels. I want to put on an RSI. Just put an RSI is a relative strength indicator. It can be a useful indicator at times. I don't always use it, but I think it's interesting at the moment. And it's because we've got all this divergence going on. So I'll explain what that means in a sec. So you can see the market's been rising, but then you come down here to this RSI. It's a 14-day RSI. You see that it's got declining peaks. So we're getting higher highs in the S&P, but we're getting lower highs in the RSI. So we call that negative divergence or bearish divergence. Now, I pointed this out back in January when I first started to observe it and said, look, maybe this is a cause for caution. The market's kept going, and I've just said, and sometimes divergence doesn't play out. So when it wasn't playing out, we started getting more highs. I just let it go because that wasn't the focus point. But just seeing the extent of this divergence continue over the last couple of months, it's just not something that I think can be ignored. So I want to stay in the market, let profits run, but I don't want to buy given the extent of this divergence. It looks like this RSI wants to pull back below 50, which I would have thought would probably mean some pause in the market, maybe a retest of these rising moving averages. So you could still get an overall upward trend, but maybe there's a pause or a pullback. That's what I start to worry about now. How a pullback looks. Look, nobody knows how that could be. It could be shallow. It could be sideways. It could be like a zigzag, which gets a bit unpleasant. We don't know, but I suspect that the RSI wants to pull back, and that probably means the market, it does open that a little bit of vulnerability, I think, to entering at current levels.
Yeah. It's funny. This keeps on making high highs on the price chart, but it's quite clear that on the oscillator down the bottom there, and maybe we could stick on. I mean, we've got a question here to do with this, and can you stick on a stochastic oscillator and see if it's printing the same thing, Jason?
I don't really have a stochastic oscillator set up, and I don't really look at them either. So rather than sort of fumble around looking and trying to figure it all out now, they tend to show similar things. So if you're seeing divergence in the RSI, I suspect on a different type of oscillator, which is using different but not dissimilar calculations a lot of the time, you'd probably find something along. I think there'd be a good chance you'd find some divergence.
Okay. All right. Well, let's have a look at the Hong Kong market, please. What's that looking like?
Quick look over at Hong Kong, and broke to a 3-month high last week after we spoke, and now seeing a bit of a pullback. Roger, I think it continues to look encouraging. It's above support. We've got that support we've put in at around 16,300. We've also got a series of higher lows and higher highs. So that's always a positive when you see that. That's the building blocks of an upward trend. And these moving averages are slowly staying around higher. So it's still tentatively building, but nonetheless it is building. And interesting to go along and have a look at the Chinese market, which is closely related. And I think this is an amplified version of what we're seeing in the Hong Kong market, in that the moving averages here are right around crossing now. And we also have that same series of higher highs, higher lows, although I think the price action looks even better in this, also because like the price is already above the moving averages. And it's interesting to look at the type of price action that we're seeing. So you can see these strong upward moves, then we get the sideways consolidation, and we've got another up move, a little bit of sideways consolidation, up move, sideways consolidation, up move, sideways consolidation. So I like to see that sort of structure developing on the chart, where you can see that there's a push to buy, which ramps the share price, or in this case the index price. And then there's a pause, and the reason you get this sideways movement is because there's accumulation. There's interest in buying as the price is pulling back, but it doesn't pull back far because there's the bids underneath the price, which is supporting it. That's where you get that structure of a nice strong move higher and a sideways consolidation. And so I think there's probably an element of short covering this as well, because like you look, this has been a market which has been in steep decline. So traders get short and then the market rallies and they've got to cover. So the bit of that's probably in there. But this is the most encouraging. This has looked since 2022. You've got to go back to this rising period in 2022. Now, this didn't turn into a major turnaround. It was, as we look back in hindsight, it was a bear market rally and further falls. But at some point, you do get a lasting low, and whether this is it now, we don't know. So my process is all about, you go with the momentum, you go with the trend. If the trend fails, we've got risk management strategies to get us out. If it runs, well, great. You stay on it and see what happens. So, look, it's going to be interesting to see how this Chinese market plays out. And as I think I've mentioned a couple of times, bearish sentiment towards China. Lows typically form amidst bearish sentiment. Now, it's not to say sentiment can't get worse, prices can't go lower, but bull markets come out of skepticism and negativity. So, you got some underlying ingredients there. So I think it's an interesting area of the market or area of the stock markets broadly to keep an eye on.
Yeah, no, it's very encouraging. It's a good point you brought up. It's the first time since 2022 that we're starting to see encouraging signs of the price once again staying over the moving averages and hopefully just retesting that new levels of support there. So it's good for those markets. Hopefully they'll catch up to the Western ones. And if anyone's investing in those stocks, obviously it'll be good for you guys in the Hong Kong market, which you can do at Selfwealth. Now, couple of questions. I'll see if there's we might get onto the one about the exit strategy very soon with one of the questions. I think that's going to be answered with one of, something coming up. There is a head and shoulders pattern on that Hong Kong, exactly. Might be able to talk about that on market structure segment, but let's get onto that now. Jason, now when I talk about market structure, we were already talking about it: support, head and shoulders, resistance, seeing those patterns before you enter the trade and using that as a bit of a confirmation. Can you explain exactly what we mean when we say market structure, or how you would interpret it anyway?
For me, market structure is all about, it's like the moving averages are the sort of the backbone of the market structure that I look at. And it's about avoiding when the underlying market structure is prices below moving averages. I'm not interested in buying. It's for me, then if the stock is below its moving averages, I can just put that stock to the side and not worry too much about analysing it further. If prices on the positive side of the moving average, so if we've got moving averages rising, then it becomes a stock to look at. So that's the underpinnings of looking at structure. And then we look at other parts, like we're talking about with the Hang Seng, how we're getting those strong moves up, and then we're getting those shallow consolidations back towards the moving averages. That's like stage 2 of looking at the structure. So probably good to have a look at a few examples. And I thought what might be interesting. So we looked at my portfolio, just had a quick look through it a moment ago. Just thought maybe pick out some of the top stocks in that portfolio and just sort of like see how the structures played out from the point of buying to other areas where maybe a position could have been added to or could have been entered at a later date. So let me just share these charts with you again. And I'll give you an example. So this was the best performing stock in the portfolio. I think it was up about 270%. It's a stock called MMA Offshore. They're to do with they do stuff with I've forgotten the details of what they do, but it's to do with shipping and marine operations. And so it's an interesting one to look at from so this is pre me buying. This is during the phase where it's just got the backbone of this is just leave it alone. It's below the moving averages. So it fails the stage 1 test. Stage 1 test is the share price above the moving averages. Now I'm using 50 and 100 days. That works for me. There are other moving averages which also work. 50 and 100 aren't magic, but 50 and 100 I find are useful for medium term, looking for those medium term trends. The shorter the moving averages, the more things you're going to have to look at, because you're going to get stocks getting above a 20-day average, obviously a lot sooner than getting above a 50-day average. So you're just going to be more active, which is nothing wrong with that. Depends what you want to do. But for me, MMA's below those moving averages, fails the stage 1 test. And then a bit of time passes, the moving averages start to cross, price gets above the moving averages. So it starts to now go on the radar of stocks to look at. And I'm looking for moving averages crossing and then prices breaking to a new high. So, and every moving average cross and break to a new high doesn't always lead to a winning trade. So based on my criteria in October 21, MMA would have been a buy, but then the share price stalled, fell back, would have hit an exit stop, would have been out of the trade. So this isn't like the magic formula for getting stocks that always go up. We're just looking for where the odds move into our favour, and we're looking for stocks with the right structure. Right structure doesn't mean guaranteed success, just means the odds are starting to move into your favour. You're buying into something with greater potential of doing something worthwhile. So this initial one failed, but then we've got another cross of the moving average. We're back above the moving averages. This green circle's where it gave a motion trader signal. This green circle's where I bought a position because I didn't have capital at this earlier stage. But what I like about looking at this structure is see the share price move from below the averages to above, has a rally, and then we get this sideways period. Just see this sideways period develop through here. This is what I love looking for when we get upward momentum in charts and we see the share price start to move above those averages, and then often you get a pause, and this could last for several weeks or several months. And this was the case in MRM, and this is what gave me the opportunity to get on board. So we get another breakout. So we start to lift off the moving averages, break to a new high. That produced a new opportunity. And then you can see something similar happen after that lift off the moving averages. We had another sideways period where the price compresses, doesn't come back much because you've got that accumulation happening. The bids are coming in underneath the share price. And because we get this flat sideways consolidation, that says to me we've got the structure where the buying interest above the moving averages is robust enough to sustain the share price and I think put the odds in favour of this upward trend continuing. And that's what we see happening. We get another breakout. So that's becomes another buying point. So it's not about buying these stocks down at the low. It's about buying them at an appropriate time and looking for the right chart structure. And that being above the moving averages and pushing to new highs, especially when we're coming out of a consolidation zone. See something similar happen through this period. Then we get another period. Like say, look at all these opportunities to get into this stock. It's not a one level stock to get into. Another rally, another consolidation back into the averages. Does the same thing late last year, and now it's rallied again. So that's what I like to look for in my market structure when I'm buying a stock. Another stock, so it's not just like a one example situation. This happens in many stocks. So where's this one?
While you look for that, Jason, I really like that example because you can see in that first consolidation spot, the price is a little bit more volatile than that second one where it sort of flattens out a lot, right? And I just want to confirm what you said because I'm listening, obviously.
Yep.
It's sort of a good indicator that there's a good base in that second box right there. So there's only there's only three ways a market can go, right? Sideways, upways, or downways. And that's like a good example where you've got sort of more volatile price action in that first box where the price is going, there's a bit more imbalance between there's a bit more balance, between buyers and sellers, and then that balance gets even smaller in that second box, and then obviously it just shoots up, and the imbalance is favoring the buyers, obviously, and then starts balancing up again, and then those boxes, as they get smaller and smaller as they go up, it's just a good indicator that hey, it's a possible chance, it's not a given, it's a possible chance that as the boxes are small in that structure, that it's a good sign, right? It's forming a base, good sign that there's less sellers.
This first box is interesting because you could say we had a false break initially. So you just it's always easy looking at these things in hindsight and drawing boxes in, but you got to think, what's it look like in real time? What would you have thought in real time? So looking at this in real time, I would have said, look, we've had a rally, we've had a pullback to the moving averages, we're starting to rally again. This is probably a buy at 68 cents. But that momentum didn't continue, didn't follow through, then started to pull back, and we get a false break to the downside. So had someone bought at 66, they may well have had an exit stop, maybe just back at the 50-day moving average. There's a good chance they're stopped out. I wasn't stopped out because I bought at a lower level, and my trailing stop is nice and wide, so I was able to see off this what turns out to be a false break to the downside. It's just choppy, as you say. It was volatile at that point. There's an area of turbulence, and this is what wide trailing stops are there for. They're to see off these sharp moves or sharp excursions to the downside. So I was able to stay in, but had you bought a later breakout, maybe you wouldn't have. But this is the thing. It's not, as I say, it's not meant to be easy, and it's just this. You always get a winning outcome. You don't, but you play the odds over time, and you're consistent. But then you put the odds in your favour. You do get the good results, and then we're back into the holding pattern. There's nothing to do in the holding pattern, and then we get another breakout. And the circle is where I actually bought myself. So I bought on. This second breakout of the range, and this time it stuck. We get the sideways back into the average. The interesting thing about what I'm doing now, just scrolling along the price action, it's a good test for someone who wants to test their, how their chart eye is developing, what their ability is to see these structures in real time. Because it's all well and good to call up a chart and just start drawing stuff, but scroll along and see if you can call where you think the balance of probability lies that the price goes, and you can see that sideways compression. I would have been positive on it at this point, and then we get the lift off. We get a little niggle out of it, but if you got a little bit of room on your exit stop, that's not a problem. Then we get the breakout, and the breakout runs, and we get the gap higher, and it's all off and away. And the other example I was going to show was another stock in the portfolio, in my portfolio, GTK. Again, I think it's 260, 270% stock. So yeah, look, nice big rally, but you can see these same structures. So first of all, we start with below the moving averages. It fails the phase one test. The underlying structure is negative. It's declining below declining moving averages. Don't want to try and pick the low. It's too hard. It's just too hard. Market's hard enough on its own, so don't make it harder by trying to pick falling stocks and identifying where they're going to finish, because it's just going to win badly. You might get a few, but it's just really hard. I prefer to make it simpler and wait for the share price to cycle above the moving averages, and then trade the breaks off a rising moving average. So this square, I've used this example before, so I've already got some markings on. This is where I was meant to buy, but I was distracted that day. I didn't buy, and I missed the acceleration phase. It's a motion trader stock, so hopefully motion trader members were more alert than I was on that particular day, and they got it. But look, as I say, there's not one particular buying point, and this is where I use market structure to establish a position after I'd missed the initial run. So as I said earlier, I don't like to chase a stock after a hard run. So I didn't do that, but I continued to monitor the price action as we're moving sideways, or as GTK is moving sideways back towards the moving averages. Had a little, had a brief but sharpish sell-off to the downside, snapped back above the 50-day moving average. I thought, look, I've got to establish a position, because if this keeps running, I'm going to be really annoyed that I did nothing. I kept watching it. So I bought a position, and then we started to get the rally. You can see that, look, here's another compression band, go sideways and break out from. Market continues to rally. Here's another compression forming now. So I'm going to want to be suggesting this is a buy as it breaks up from this period. Didn't quite get going on that occasion. That's why this is another reason why it does help to use, people who use 5% stop losses and things. It just makes it hard when the market doesn't tap a new high and keep going. Sometimes it taps a new high, pulls back, it's not quite ready. But this is still a nice sideways holding pattern, which this is in, and then it does go. And when it goes, it goes a good distance. Another compression, you can see another compression here above the averages, another one, and it continues. We're having another one just now. So whether this one's going to go again, or whether it does have more sideways, or is it peaking and it's going to make its way down? Time will tell. But that's the sort of market structure that I'm after. I'll show you the stock I sold today and yesterday, and I'll show you how the market structure is changing. A company called Duratec. This had been one of my best stocks. It ended up exiting at around 160%. This is where I got in. We don't need to go through all the setup again, because what I said before, fails the stage 1 test below the averages, above the averages. You can see all the the compressions towards the moving averages. But what's changed now? Why have I decided that this is a selling point and this previous one wasn't? Well, firstly, there's a trailing stop on this previous decline in October. September, October last year didn't trigger the trailing stop. This one has. But the other thing which is different, and where the structure for me is changing, is we've gone from a situation where we've had a share price which has been generally trading above the moving averages, had a brief period below, but that was okay. That will happen when markets pull back and go sideways. A brief period below the moving averages is not a deal killer. That's fine. So I stayed with that, got it off to a new high. But what's happened now? Come back to the averages, rebounded, come back again, fallen below the averages, rebounded to the averages, and fallen away again. So now we've got a situation where the price is starting to lose traction below moving averages, which are also starting to roll over and starting to cross. So the structure of this chart has changed. It's changed from a stock which is rising above rising moving averages to now losing its footing as moving averages are rolling over. So I've got a good gain. I've got a great gain from where I got in over, when's that? October 22. So what, 15, 16 months, nice 160 odd % gain. It's time to take that money off the table and move on. It's really interesting. I was talking to a friend yesterday who's successful. He's a successful friend, but in a different field, not in the stock market. Although he knows his stocks, he picks some really good ones. He does well. And I was talking to him about how I exit some of my stocks when they're not the most liquid of stocks. So Duratec is, it's reasonable liquidity, but it's not CBA or BHP by any means. It's a smaller to midish cap stock. And I said I'll often sell them on a rebound. So they'll trigger the stop, and if they get a bit stretched below the moving averages, often you get a rebound like we saw in February. had a bit of a sell-off below the averages, you get a rebound. And often if you've got a bit of position, you don't want to just hit the bid, and because maybe there's not that much volume on the bid, sometimes it's simpler if you set an offer, you let someone hit the offer, and that often happens during a rebound. So that's what I tried to do with Duratec just over the last couple of days. Hit the trailing stop yesterday at $1.09. I think it was $1.09. Then started to rally through the day. I could see there's a bit of momentum into the rally, so I just let it go. I sold it on the close at the day's high. I sold half the position, and I thought, look, I'll keep the other half and see whether we get another bounce today. And market opened at $1.20, and I had my order at $1.20 already for it, but then someone swooped in right on the open and took the $1.20 volume, so I ended up selling it at 16.5. So I accepted a few cents lower, which was about where I got out yesterday. But I used that rally to exit a decent sized position because it's moved up quite a bit, rather than just trying to hit the bids as the price is in decline.
Fantastic. That is a great example of both ways, seeing on the way up and then being able to exit a stock and being able to seeing the price obviously on the way down. There's, to Kirby's point before, there's a bit of a head and shoulder pattern there happening at the top as well, which is, showing that negative price action once again and starting to confirm that downwards movement, right? So that's very good, Jason. Fantastic.
Now this stock could be it. That could be the selling. It could base here. And the point my friend made yesterday, he said he struggles to sell a stock which has hit a low and starts to bounce back because he goes, oh look, maybe that's the low. Maybe this is the turnaround which is going to take it back up. So he struggles to sell into a rebound, as I often do, because I use that as a way to get a little bit of a better price and more liquidity. I think that probably a lot of people would think like that as well. They don't like, they'll say, oh, look, okay, it's going up now. Maybe this is it. But it's the change in structure that I don't like, from being above moving averages to below moving averages to moving averages rolling over. So I think the odds have now shifted towards Duratec not re-engaging with the upside or re-engaging with its uptrend at least in the over the next several months. Like it could do all sorts of things. It could just do a V-shaped recovery and go off to new highs. I don't know that it won't, but I think the balance of probability. Like what worries me is that if I do nothing and I just hold and hope that it's just going to stabilize, maybe it does stabilize for a few weeks, and then we get that sideways compression into the moving average. But the reverse is what we were talking about on the upside. So the reverse occurs on the downside, where you get those averages start to roll over, price compresses into it, and then you get the breakdown. And that's what I don't want to be a part of. I don't want to be trying to exit a position into a potential breakdown. So that's why I say, look, I can see there's a change in the structure. I don't want to be a part of compression below declining moving averages and breakdown, because you do that, and then you get another rebound, and you say, oh look, maybe that's it, and you keep holding, then you get another one, and you keep chasing your tail. You keep getting rebounds, maybe that's it. And before you know it, you're back to where you got in, and you've just smoked 160% profit. And people do that. It happens all the time. The reluctance people then anchor at the previous high and say, oh, look, if it gets back to the previous high, well, then I'll sell. Or if it gets halfway back, then I'll sell. And they always say, oh, but I'll sell if it bounces. But you run yourself into problems if you don't have that clear-cut exit point and you pull the trigger on it and you say, look, it's been a terrific trade, but I've got to say goodbye. I've got to wave this one on and I'll move on to the next one. And if it rallies from here, so be it. I've still done really well. But the worst thing for me that can happen is to hold on and give the whole thing back. That's diabolical. I just can't do that. to see it go to a new high, well, that's going to happen. To hold on and be holding on at the lows at where I got in, I can't. That would be, if I did that, if I was doing that sort of thing, I shouldn't be trading individual stocks. You can make those mistakes. We all make those mistakes, and I have made those mistakes. But if you make them and you never learn from them and you keep doing them, well, then it's a hard game. You can't be doing making the same mistakes and hoping for different outcomes all the time. You've got to say, look, that doesn't work. I can see it doesn't work. I can see the structure's changing. I've got to protect capital. Riding things all the way back down, it's not conducive to doing well in the stock market.
Yeah. Yep. Good points there made, Jason. All right. So let's get on to some of the questions we have now. Let's just quickly, on last week, someone asked about a depth of market. Now, from my understanding, a depth of market is just another way to say market depth, right? So it's just showing you buyers and sellers on either side. Now, this is probably relevant to the next question. All right. It's who can see your trailing stop loss orders, right? So let me just put it out there with the Selfwealth platform, because I'm not 100% sure how other cash equities platforms work, right? But with stop loss orders, when you put them in the market, a stop loss, it's not actually, when you put the stop loss order in the system, it's not actually been put in the market yet until the price is triggered to the downside. All right. So with a stop order, you can only put the stop order, you can put the trigger price below the current price. You can't put a stop order, like a trailing stop, above the price that you got in. You've got to put it below the price, right? So, and that actual trailing stop, so to speak, if you were to move that stop loss order, that will not be shown to the market until the price actually triggers, right? And then your order goes into the market, and it will be shown on the market depth. So I hope that's clear for everyone, in terms of that the way stop loss orders work. Trailing stop losses, same thing. It's I know the system's out there, but I'm assuming a trailing stop loss is not. It doesn't go in the market until the actual price actually triggers. Then it'll go in the market, right? Whether they're automated or whether they're manually driven. All right. So this is probably relevant to the question here from Darren. With the example, you don't set a failing sell instruction with Selfwealth. Instead, you set a target on TradingView and manually do the sell yourself, Jason. How do you do it? How do you manage that stop loss order?
I actually don't place a live stop loss. I just manage the exit myself. Now, there's a really important distinction I need to make. It's when I've been trading in futures markets, I've got a live stop loss from the minute I place the trade, because a futures contract is different to an individual share. A futures contract it's a leverage product. A CFD is similar. So if I'm using leverage, well, then I'm going to have a live stop loss in the market. But because with my portfolio, there's no leverage in it. It's just it's capital. It's capital, and it's spread across a portfolio of up to 80 stocks. So the individual risk with each stock is tiny compared to the overall portfolio. So I'm not really. I don't want a stock to fall 50% overnight, but it's not going to blow up the portfolio if it does. So for me, it's easier to manage on an end of day basis. So at the end of each day, I'll run the data through the system. I'll see which stocks have exited, and I'll move them on the next day or soon after. Maybe I'll try and play around with it and get a rebound and get a better level. And so I'll manually manage the process. So that's going to be different for everyone. Some people like. I've had members tell me, my motion trader members say, look, I really like placing a live stop, because then when the levels hit, I don't sort of look at it and go, oh, look, well, maybe I should give it a little bit longer. It helps them. It's an enforced discipline. It's an enforced discipline to sell, because it's easy to add your stop loss in when it's well below the share price. There's no emotional pain with that. But when it actually comes to the moment of placing the sell button, placing the sell order and pressing the execute button, then some emotion comes into it. So having the live stop loss you place when it's unemotional, it does help some people. So there's no one size fits all approach. I think except if you're using leverage, then you really do need to have a live stop loss, I think. But yeah, it's a variable situation depending on your own situation and your own preferences.
Yep. All right. Fantastic. Well, let's get on to a question from last week. So we'll back off this what we've just talked about, talking about stop losses. Do you use limit orders when you have your standing trailing stop losses, straight like stop orders, or do you just put in the market? How do you just do a market order?
Yeah. Well, I'm not running a live trailing stop loss, so I don't have it in the market as we're just discussing. But when I do place an order to sell, I almost always use a limit, and this is something we discussed maybe last week and the week before as well. Look, if you're trading CBA or BHP, almost always you won't need a limit unless it's the COVID collapse, and then maybe you need to think about it. But generally, a retail investor won't need a limit in a big liquid stock. At market will typically do the job. But if even if it's a mid-cap stock, they don't always have all the volume at each level. So I'll place a limit. I did so when I was selling Duratec. I had a limit. I said they didn't do at market, because you can do at market, and just as you press sell, someone else press sell, they get the stock, and then what you thought was there is not, and the next bid might be 3, 4, 5 cents below. So I'll even put a limit on in that case. You want to have an orderly process when you buy or when you sell, and the best way to have an orderly process is to use limits rather than just putting in an order and it goes clunk 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 if you're buying, or clunk 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 if you're selling, and you get a feel you weren't expecting.
Yeah. And once again, if you're not monitoring it when it happens, you get a feel when you put in a market order, it becomes a market then limit, right? So you put it in, you get an unexpected feel, and then you're limited to that price, right? Regardless of and you might not even be monitoring, and you'll come to a surprise that you weren't welcoming, right? So, or weren't wanting. So
I guess an interesting situation is, say you go on holidays and you're not monitoring, you don't want to monitor, and you've got a stock, you've got a stop loss at a dollar, and you put a 5 cent limit. So trigger to sell at a dollar, limit of 95 cents. So you're doing all those things we just discussed then. But then there's either the market has a sharp fall, or there's a company announcement and it doesn't trade between $1.95, or there's not enough stock for you between those levels, and the next trade's at 90 cents, and then 89 and 85 and 80 and so on. And then you come back from holidays and the stock's down at 60 cents, and you go, oh, well, I'm okay because I got out. And then you look at how the price actions played out, and you actually haven't, because you had a limit, and that price region never traded. So I think the takeaway from that is, you can't just put your portfolio on autopilot and just assume everything's going to be right. You do need to have a degree of monitoring, even when you go on holidays. And it's not hard anymore with the internet. It used to be hard, 30 years ago. It's not hard now. So unless you're trekking in Kakadu and you got no internet, well, sometimes it's all risk, isn't it? There's going to be risk sometimes with things you do, but much of the time you can keep an eye on things, and I think you need to, because those situations like I just described can happen, and if you want to be using those stop losses, using limits, be aware that your levels mightn't trade, and you mightn't get out when you thought you would have been out.
Yeah, it's a good point there. Let's get on to Alan's question here. You speak of accumulation of unfilled trades, which creates the market depth. This really represents the support for a stock, I guess. Please confirm. Sources of this is non-retail investors. Useful.
All the interest to accumulate a stock isn't in the market depth, because there'd be plenty of stuff off screen which hasn't been inputted into the system. So the market depth it gives you a guide of what's around, but it's not the entire universe of interest in that stock. There might be, large funds won't put all their orders in. They'll just feed their orders into the market as at the pricing points when the volume is suitable. So it can help you differentiate between a liquid and a much less liquid stock, but it's not telling you everything.
Yeah, exactly. This is the dark.
In terms of finding out in terms of assessing where those support and resistance points might be, I think the chart tells you more than the market depth.
Yeah.
Because people will be acting off the chart points, but not necessarily have orders in the market.
Yeah, that's a good visual, that chart. Like, not worrying so much about the market depth sometimes, but having that visual and seeing where that support is starting to accumulate. Right. So it's a good visual having that chart. I think there's not really. I mean, there's some questions in there which I'd love to answer around other technical indicators, but we probably won't get onto them because that might open up another, some just things that we're not going to cover today. So apologies for that. Maybe we'll cover them into a future session. But I've got a question here from the past as well, and we might just quickly touch on that if that's okay. We might be going over time again. My apologies, Jason. But how do you manage risk? So this goes on stop loss once again. How do you manage risk if the ATR grows? Meaning that if your multiplier is 10, right? And we had a question about stop loss before, whether it's 20%, but you actually use an ATR. So how do you manage risk if the ATR grows? Meaning that if you multiply by 10, so does your risk. Does that make sense?
Yeah, it does. So the width of the trailing stop will increase as volatility increases. And it's, well, I guess for me, risk, the risk is what you're prepared to lose when you place the trade. So you might say, I'm prepared to lose 10%, 15%, 20%, 25%. That's your risk. Once a trade is up and running, so say a trade is now up 50%, I don't necessarily view my risk as being the distance from the trade high to the trailing stop, because I'm in profit. So that's more volatility within the position. I do know what our viewers meaning from that, but it's like, and this is where people struggle to stay on large trends because they're always worried about how much they're going to give back. It's like the thing with the trailing stop, you are, even though it's the thing with an ATR stop, even though the trading range is increasing when the volatility increases, you're still managing your risk because you're being consistent in the way that you're applying your exit mechanism, and it's a calculated process. So even though you're allowing for more volatility, it is still managing risk because you do have an exit point. I'll give you an example. So I'll look at a stock. So this is a stock I've got myself. So the ATR stop, it's really giving you an appropriate exit level for the given volatility in the stock. So it's got if you're going to manage based on the stock's volatility, which I think is the best way to do it, you're going to get that variability. So this is Southern Cross Gold, and it was in my portfolio when we looked at it earlier. It's up about, there's my entry point there, 80 cents, it's up about 120, 130%, thereabouts. I was in November. So, quick thing on market structure. Below the moving averages, above the moving averages. There's our compression band through there. I think the motion trader signal might have been a little bit earlier as it was breaking out. I didn't buy on the breakout because it was in the same day. I think it went out to members, so I don't buy on the same day. I'll buy the next day or soon after. if I'm going to get in. But because the share price started to pull back, I then thought, oh, well, look, I've got the luxury of just watching this for a little while. As it compressed back to the moving averages, that's where I bought. I got in just as prices were close to that 50-day and they started to rise. That's not the point of this, though. The point is the ATR stop. Now, so this is up 120 odd percent. Now, say we use a percentage-based trailing stop. What do we use? Like a lot of the, like I know ComSec, because people tell me they've got a limit of 15% for their trailing stop. So you can't set a trailing stop which is greater than 15%. So putting on a 15% stop on this, or maybe it's a 20% stop or a 25% stop, it's all well and good until you get a sizable pullback. Now, let's use the high point in December, 15%. So if you're using a 15% trailing stop, it doesn't give you much room from a high, does it? You're out. And you say, okay, well, I won't use a standard 15% with my, which I might get through some of the brokers. I'll set my own stop at 20%. Well, 20% has you out well before the low. 25% has you out well before the low. This pullback is 37%. So what's standing between my entry and 120% open profit is a 37% decline. So this is why the ATR is so valuable. Yes, it will allow for more volatility, or as our viewers said, risk, depending on how you want to look at it. It does allow for more risk, but does so for a reason, because it's adjusting to the situation with this particular stock. So this is a stock which has a history of movement. So the 10 ATR stop will be able to see this pull back off, whereas your standard percentages probably won't. Not too many people just set a 40% fixed percentage stop. They tend to be a lot closer. Let's put the ATR on. I'll put an ATR on this and we'll see how it goes. So this isn't the same as the motion trader stop, because I've made a few adjustments to it to change how it works. So this is on a 3. The default's a 3 because people love these close trailing stops, which I don't think are particularly great. I'm going to set it to 10. It's calculating over the last 14 days worth of data, and we use a 10 ATR stop, and we're still in the trade. And now someone will look at this and say, "Oh, but look, you're going to risk giving all this back." It's like, well, but this is how I stay on these big trends. So you saw my portfolio earlier, where I've got this morning, before I'd sold the rest of Duratec, I had 7 stocks which are up over 100%. And one of the big reasons for that is because I use these wide trailing stops. You've got to give these stocks room to move around, or you're going to get bucked off, because they've got every 100% gain is typically going to have several pullbacks, which are between, say, 15 and 30%. And this one was 37%. So if you're trading your 15% or your 20% stop loss, you don't get over a lot of these hurdles. And people say, "Oh, but I'll get back in." But it's so much harder, easier said than done. I just want to keep it simple. I want to get in, and I want to stay with it until it ultimately comes back to the trailing stop. Now, should this start going sideways and the ranges start coming in, well, this trailing stop will increase, even if the share price doesn't go any higher. It's just high at the moment because we've got all these big gaps higher. It's unusual that a stock, very rarely do I see a stock of this size. You might in like the 1 and 2 cent range, but a $2 stock doesn't usually go up and then come cannoning straight back down. It can happen, but it's real. I'd say it's rare. I don't see very many situations of that at all. So people think, "Oh, I'm going to lose all that." That's probably not the case. This stock is probably going to tighten up, and the stock could well go a lot further. So yeah, I think getting your head around those ATR stops is really important. I think it's the biggest thing that holds people back from getting those big 100% plus gains.
Yeah, and just so the viewers understand, like I can see that ATR, it's calculating, so it's the average true range of the price over the last 14 days. But this specific indicator, which is like a stop loss indicator, it's calculating that bottom line off the previous high. Is that right? Off the previous high.
Yeah. So the trailing stop,
Not moving,
it
up
hangs
and
off the trade's high. So it's using it's today. It's using today's high as the anchor point, and then it's calculating the width of the stop by doing, multiplying 10 times the average trading range over the last 14 sessions, and that's what that calculation comes to. And that's what I use for all my trades, but with my variation where I've just tweaked it a little bit, but it's pretty close. My trailing stop would be basically about the same as this currently calculates to. I'd expect.
Yeah. All right. No worries. Thanks for explaining that. I think we'll leave it at that for the questions for today. There's maybe look. I mean, there's a question in there about does MAs work for scalping trading? I mean, we're not scalpers, so but look, everything works, right, Jason? You just got to work out the system. I'm assuming, is that right?
Yeah, scalping's never been my thing. Never focused on it. I've always been looking for some sort of trend, even if it's intraday. If I'm trading, when I was back in the bank looking at the 5-minute charts, I'm still looking for a trend. I'm not, scalping. It's never been. I've never seen a way to make that work for me.
Yeah.
It's not my game.
Fair enough. No worries. There's 3 quick stickers. We'll just do these ones because I don't even know what market they're in. If they're in the Australian market, they don't seem to be. So let's just have a quick look at them. ABSI.
Okay, let's see. Give this NASDAQ, I imagine. Yeah, trends in place, pulling back to the moving average. It's the structure remains good. A lot will be dependent on what happens in that US market. If it does have the pause, you'd expect this to pause too. But it's if I've got this, I'm continuing to hold it, and I've got that trailing stop loss.
Okay, fantastic. The next one we'll do is EXAI. I think these are all biotech, so I've got a feeling they're going to be similar.
And just again on pullbacks, look, this has come back 27%. So if you're using a 15% or a 20% trailing stop,
you're out.
You can't trade this thing on a medium term basis. But your ATR stop is going to do I still have it turned on? Yeah, your ATR stop, you're in at the breakout, you're well and truly in this. It's I know people see this gap and they get scared by it, but you gotta get apply to a big trend and see what it does. That's where the magic happens, when you get on the big trends, and that's where the money is made.
All right.
Sorry, what was that code?
EXAI.
What's this? This is just range bound at the moment. So there's nothing happening for me. We've got no guidance from the moving average. We don't have a trend. We've had a downtrend. Now it's just grinding along the bottom. That could go on for months or years, or we could get a breakout. If we get a breakout, well, then we start looking at it. But at the moment, there's nothing here that suggests that we should be ready to take action.
Yeah. And RX.
Let me just get rid of that. Yeah, look, there's momentum there. It's such a volatile play, though, isn't it? Like, you get these rallies and these. It seems to be one you certainly don't want to chase, because look at the pullbacks. It's not one that I especially like. It's just so volatile. If somebody wanted to have a liked it for some particular reason, well, I guess it's potentially could be bought at current levels with a stop loss just below the a bit below the 100-day moving average. See if it repeats what it did in January. It comes back to the averages and then rallies again. But there's no guarantee that's going to happen. Like, look at how it behaved back here in 23, where it rallied above, came back a bit below the averages, gapped higher, and then came well back and continued below. So I'd probably leave. Well, I'd leave this one. But if someone's really interested, there are ways to play it with managing risks at current levels.
Okay. Sorry, and last one, NXL. Back to the Australian market. Oh, no, this is American market, NASDAQ.
Was that MXL?
NXL, yeah. Oh, no, NXL. Sorry, with an N.
NXL. Yeah, this is an interesting stock. I looked at talking about this on my Friday strategy session video, but I didn't think it had enough liquidity to really talk about, to bring up. But given someone has brought it up, I think this is an interesting stock. It's got the right structure. It's trending higher above the moving averages. It's pulling back to the averages, finding support and then rallying again. A little bit of that sideways consolidation at the moment. Whether it's ready to break and run now, or whether it's going to have another pullback, that's entirely possible, and then maybe a run higher. But the underlying structure is good, and it's like, this is the avoid stage, and this is this is interesting stage. It's worth having a look at, and something could well come out of this sideways consolidation as those moving averages are catching up. Very much like what we were speaking about earlier on.
Yeah. All right. Very good. Jason, I think there is one more question right from the start. Are you still running? We got a question. Are you still running?
Yep, I am, and I'm scheduled to go out running as soon as we stop speaking. So no, still running, still competing stuff. It's good fun. Keeps me fit. It gives get some challenges, beat previous times and such, and beat my kids. That's a challenge. I lose that challenge most of the time, though, unfortunately.
It must be. Well, you'll have no problem in beating me. So if you ever want to come down for a run, Jason, I did a 14K run for kids in Melbourne on the weekend, and
nice one.
Pretty hot, and it was the furthest I've run in a long time. But good cause. So it's a great exercise. Good for the trading. Good for the mindset, right? So I recommend it. Yes, share the ID. I will. Do you use Strava, Jason? I know we're getting off topic here, but do you use Strava?
I've got a Strava set up, but I haven't used it for years. It's just I got too many apps, too many gadgets. It's too much. I use a Garmin. I got my Garmin on, and so I track all that stuff. I just don't bother uploading it.
Yeah. Well, we might have to start another running live show very soon, Jason. The way this is going, all good. All right. Thank you very much, everyone, for coming. Much appreciated. Once again, thank you for your questions, Jason. Thank you very much for your expertise. It's just fantastic having someone with so much knowledge, being able to week in, week out share their thoughts. So thanks again, and keep on liking and subscribing, and keep on sending your comments and things in, and we'll look at it going forward. All right. Thanks everyone. Thanks, Jace.
That was fun. Thanks, viewers. Thanks, Rog. Thanks for all the great questions, everyone. And look forward to next week.
Take care. Bye-bye.